Okay, welcome to the beginners session. So if you're new to trading, there's a couple of things, first and foremost, before I even get into the charting, you need to understand. You need to understand if trading is for you or not, right? And there is a 30-minute video going into the depths, the 5 things you need to understand when it comes to trading. I'm not going to go into it because it's 30 minutes long, right? But there is a link in the chat. There's a command in the chat that you can type. I think it's called beginners or beginner. That gives you to that link. So after that's done, it's a mentality. It's called mentality. Thank you. It's called mentality. Okay, there's a command called mentality you can put in, and that gives you to that video. 30 minutes long. Blah blah blah. Right. So after you've understood, okay, trading is for me. I want to get into this thing. All right. First and foremost, you want to look at it from a TA standard, meaning technical analysis, right? Technical analysis basically means you're looking at what's happened historically to try and anticipate current and future price. Okay. Now there's many ways to use TA. All right. But what I'm going to show is a couple of simple ways that you can analyze things and look into things without knowing too much about TA, but just getting by, right? You can just get by just by using a couple of things, right? So first and foremost, what you must always do is go to the largest time frame and trying to understand what the move is. So we're looking at Netflix as an example. The move is up. In the higher time frame, yes. Now, what you also have to understand is just because the higher time frame says the move is up, which is obvious, it doesn't mean the current move is up. Okay. So what you need to understand is, okay, you've identified the higher time frame is up. It's been up for decades, right? So what you need to identify next is, okay, what are we doing now? What are we doing right now on the 1st of September, or the 5th of September, sorry, should I say? Right? What are we doing right now? What is this thing doing right now? So for you to understand that, you need to go to a smaller time frame. So you can go to the weekly or the daily. So I'm going to explain it in the weekly because it seems a little bit more easier in this chart. Okay? And what I'm going to do is I'm going to try to understand where the peaks are, where the highs are, right? And I'm going to use 2 different informations to see if this is the high or if it's not the high. Okay. One of the information I'm going to use, okay, is what, first of all, just eyeing it, just looking at it, it seems like this is the local top, right? Or it's the all-time high, right? And just knowing that isn't helpful in any way. In terms of TAs, in terms of price action, it is not helpful. Just understanding that's the top isn't going to help you, right? So what I'm going to try to understand next is, why is that the top? What made this the top? Why couldn't it go higher? Right? So the follow through on this being the top is because it broke levels. And in this case, it broke this level right here, which was the previous top. Right? Now you know it's the previous top simply because we have levels being tested. Now, let's say if we hadn't tested that, then it would have been a little bit nonchalant. It would not have been a thing. Not really. Now, that's not guaranteed. This doesn't need to always test. Okay? Always testing is not a thing. But majority of the time, if things break levels and retest it, what you call that a confirmation, right? So what we have here is a confirmation of this being the top. And what this is called in trading is this is now called a downtrend. Okay? We've understood in the higher time frame that this was an uptrend. But because of this happening here and this being retested, now this is a downtrend. Now, what does that mean? It means that price is going to keep going lower and lower and lower. Now you might be asking yourself, okay, so when does the downtrend end? So we've understood it's a downtrend. So now we're going to flip the the chart upside down, and we're going to look at it on the inverted and go, okay, the same as before, previous levels to hold, previous levels tested. Now this is currently a downtrend as well. This is a downtrend. So what does that mean? It means that we were in a downtrend, but we're potentially recovering from the said downtrend and potentially going up to test this level, which from historically we haven't tested yet. So imagine as if an untested level is like a magnet. It is not guaranteed to get there, but it is a magnetic zone. It is a zone of confluence. It is a zone of practice, price action. So what that means in simple English is if it has not been tested on the downtrend, it will probably be tested on the uptrend. Right? Which this potentially is currently. Okay? So how do you use these informations, right? We went, try to understand the trends, try to understand the downtrend, try to understand the uptrend. Now, all of this is pretty basic stuff. A lot of these have a lot of nuances, which everything in trading does, okay? But I'm not going to go into all the nuances because this video would be God knows how many long time, because you would need to you need to trade for years to understand all the nuances, all right? So this is the basic stuff. Now, if you've understood this, this is a good starting point for you to be on the stream and just pay attention and record the stream and to understand the next steps. This is the first step. This is TA or Trading 101. Okay? This is the first step you need to understand. If you do not understand this, the rest of the things will be weird or not easy to understand. Why? Because you don't know the basics, and this is the basics. Okay? Before doing high-level quadratics, you need to understand simple multiplication tables. And this is what this is. Okay? So, you've understood the downtrend, you've understood the potential uptrend. Now, why do I say it's potential uptrend? Why couldn't this be a guaranteed uptrend? Now, the reason it's not a guaranteed uptrend is the same as before here. You knew it was a downtrend here, but we lost levels. And in this case, we've gained levels, yes. But then again, the same as the higher time frame, we can go to the 4-hour and go, okay, what are we doing on the 4-hour? Oh shit, on the 4-hour, we're in a downtrend. Do you understand what I'm saying? So, on the higher time frames, on the weeklies, this is a potential reversal. On the 4-hour, it's gone back to downtrend again. Why? Because we've failed levels and we retested levels and we're making new lows. Now, for this to continue to recover, what we need to do is something called gaining lost levels. Gaining lost levels means these are the levels that locally took us to make new local highs, higher than this highs, and so on and so forth. So since this was the start of a new local high trend, if you will, you need to now understand if we make new lows, which is what we've done here, we've made new lows lower than these lows. If we make, and after we make new lows, there's two ways things can happen. One, either we fail to gain and we continue going down, so the downtrend is going to be a continuation, or we gain levels, and in this case, it will be a gain of this level. We gain levels, and we must hold the said level, and there's a potential reversal. And this is what you will be trading. Enough time frame. It's not the daily or the weekly. You don't need to wait for too long, but it's not too small a time frame either. So I would always recommend looking at the 4-hour in any charts. 4-hour is your Goldilocks zone in any charts. An hourly, a weekly might be too high a time frame. You might think to yourself, oh, I'm not trading enough trades in this time frame. Smaller time frame might be too noisy, because there is going to be noisier in smaller time frame compared to higher time frames. Why? Because in higher time frames there's going to be more confirmations. In smaller time frame there might not be as much confirmations, thus creating noise. Right? So 4 hour is what I would say is your Goldilocks zone, where it's not too hot, it's not too cold, it's just right. Okay? So that's why I'm using the 4 hours as an example here. So what I'll be looking for on Netflix is, okay, this is the previous level we gained and tested that made new highs. We made new lows below it, so we failed. So for us to retain the uptrend, which we have currently lost, for us to retain the uptrend, we need to gain this level again. Why this level? Well, this level because, like I explained before, this is the local level that took us to make new local highs. This is the local level that we tested, that we bounced off. Imagine a ping pong table. This is the table we bounced off, the ping pong table, to make new local highs. So this is the most local one. Now you can argue and say, what is it? Why is it not this one? Because this is the most local one. That's why I didn't choose this one. Okay? Because this is the most local one. You want to look at it from a local to local perspective. Because in any price action scenario, price is going to do something called failure to failure moves. And as price goes more and more to the right-hand side, until we have a big breakout or a big down move, time frame is going to get squeezed tighter and tighter and tighter until we get a big pop or we get a big drop. So you need to look at the most local one, because if you look at the older one, it's what is called unrealistic framing. Okay, it is outside of the frame of what you think is going to happen. So in other words, it's unrealistic. Okay, because all you're looking for is, you're not necessarily looking for it to moon here. All you're looking for it to do is hold this level and for you to make at least 4 risk to reward or 3 risk to reward trade. That's all you're looking for. You're not looking for it to go to 500. You're not looking for it to go to 300. All you're looking for is that 3 to 4 risk to reward trade. Okay? That is the reason why you're doing it this way. Because if you start thinking about it going, oh, I'm going to look for it to go to this way, that includes unrealistic expectations, right? That is unrealistic expectations. Just like the women nowadays, you know, if you go in the dating scene, thank God I'm not in the dating scene, people go, oh, I'm looking for a man who's 6'5", and, you know, I want him to be earning 500K a year. And, you know, no, unrealistic. All right? We're not rappers. Okay? That's unrealistic. So when you're trading, you have to have and 10-inch cocks, right? You have to have realistic expectations of your trading mechanism. And that's what this is. Because as a trader, you're not trying to win the lottery. You're trying to make realistic gains over and over and over again. Because the aim of the game in trading is not big gains. The aim of the game is consistency on your trades. Because if you're consistent, you are profitable. If you're profitable, you can be more consistent. So it's a full circle. Okay? Because if you're consistent, you're profitable, you start becoming more and more confident. If you start becoming more and more confident in your TA, you start trading more and more things that's maybe was uncomfortable before. So you widened your way of trading. Now, after understanding all of that, the next thing you need to understand is the idea of risk. So when I say risk, it does not mean that, oh, I'm going to have an entry here. Let's use this as an example. I'm going to have a stop loss here, and I'm going to have a target here, and I'm going to risk, 1% move, or in this case, 2% move. Your risk is a risk to you. The risk is the risk to your capital, to your portfolio size. So when I say 1% risk per trade at any one time, it means at any one time, if you get stopped out, you are losing 1% of your account at any one time. So that means that you can take multiple trades, but you need to divide your risk in multiple trades. So let's say you want to take a Netflix trade, a Facebook trade, an Apple trade, a Microsoft trade at the same time. Let's say you want to take 5 trades at the same time. So what you need to do, simple maths, you need to divide 1% risk by 5 and take those individual trades to whatever that risk is. And in that case, it's 0.2. So each of your trades on those 5 tickers will be 0.2%. Why is it that? Why isn't it 1% each? Well, the simple answer to that question is, what if all 5 of those trades break levels? Because all stocks have certain parameters in the way they move. They don't move the same way, but they move similar. So if you're taking trades on things that are moving similarly, it means there's a higher probability that if one trade doesn't work out, the other trades won't work out either, or they will get stopped out as well. It's the same thing when you're taking trades in altcoins, right? If you're taking a trade in an altcoin, and you're taking a trade in multiple altcoins, since all altcoins have some sort of behavior to the price of Bitcoin, if Bitcoin dumps like crazy, then it will stand to reason all your altcoins will also dump like crazy. So, at any one time, you want to take 1% risk. The specific word being at any one time. Okay? Now let's hypothetically say, okay, you did get your entry and we did pump and you took some profit targets and your stop loss is now at profit. It means you can move on from this trade. You can take another trade because you've already moved your stop loss into profit. This trade is not going to lose you money. The worst case scenario is you're going to make money off this trade. That is your worst case scenario. So if that is the case, it means your trade is in profit. You can move on to the next trade and do the same thing with the next trade and then move on and so on and so on and so on. Until you get to a portfolio, like for example, in altcoins right now, I have 65 plus trades running. It's not because I took 65 longs at the same time. No. I took some longs months ago. I took some of those longs probably a year ago, maybe a year and a half ago. It's because I'm still holding on to it, is because a lot of the shitcoins that I have the longs on haven't broken enough levels. For example, if I'm long from here, if it's at this stage right now, I'm not going to close that trade. Why? Because it hasn't broken the trend enough for me to feel comfortable that I'd go, all right, you know what, this is it, I'm done with this trade. Why? Because there is more than enough substance between my entry to the current price that I feel comfortable that it hasn't dumped enough, right? So in this case, as an example, let's say this is 100% moved, it dumped what? 12%. So I'm still 70 something, 80 something percent profitable in a 100% move. So that's why I have not closed that trade. Okay? Now, this is a decision that you need to make from a stance of, like I said before, of whether it's broken levels or not, or if you have hedges. I'm not going to go into hedging in this video because that can get a little bit complicated. But that's it. And all the things I've explained, you have to look at it from a risk to reward scenario. So we looked at how to look at TA, we look at how to chart, how to use price action, how to look at reversals, because the only thing you need to pay attention to as a trader is reversals. Reversals are the only thing that matter. So that's the only thing I've taught you here. Because reversals give you the big money. They are the trades that net you the most gains in any trading scenario. There are many trading scenarios, because it differs from people to people and the way they trade. But reversals are the best ones to use for any traders, whether they're new or you've traded for decades, because they are the most optimal to trade, most efficient and optimal to trade. They net you the most profit. At the end of the day, that's what you're looking for. Net profit, not profit, net profit. Okay? And you always want to take trades that are at least 3 risk to reward and above. What does that mean? It means that you are risking $10 to realistically get $30, at least. That is your minimum requirement for a trade. If you are realistic and you think this is going to go to this level, and that does not give you a 3 risk to reward, then you do not take that trade. That is not a trade that you take. Full stop. There is no but what if, no. Either it gives you 3 risk to reward or you don't take it. That is that easy as pie. There are plenty of tickers that you can trade. Right? There are plenty of tickers you can trade. Okay? There is plenty of fish in the sea. You don't need to get married to this one. Okay? Let's use this as an example. In TradingView, there's a very simple thing that you can use, which is this long position thing right there. And this is your entry, like I explained before. If we gain the level, this is your entry. And your realistic target is this right here. All right, let's assume that's your realistic target. And you are trying to make it 3 risk to reward. As you can say, it says risk reward scenario 2.6. You want it to be 3 at least. So you move it up. So it's 3 at least. Currently it's 4. So it's at least 3. So that's fine. Obviously, this is a hypothetical scenario, but that's the way you want to be doing it. Now, if you don't know how to do that, I just explained it, right? It's right here. It's a long position or a short position. You can do it both directions. Okay? Now, finally, and probably the most important thing, after using all this information, or after absorbing all this information, and trying to put it into practice, because you're not going to get it on your first try, you probably need to watch this video over and over and over again to actually grab it, right? Because you might have expectations from other places and other videos and YouTubers and all that stuff that tells you that this is not the way. And this might not be the way. And this couldn't be the way. This couldn't be this easy, or this might not be this easy. And so on and so forth. That is why I want you guys to try it out. If it's for you, it will work. If it's not for you, it's not going to work. Now, why do I say if it's not for you, it's not going to work? Because what tends to happen is people use all this information, they get confident, they get cocky, and then they throw out all the information because they've already made money. And what they do next is just don't use this information to take their next trades. And guess what? They're going to lose all the profits that they made earlier. And they're going to go back to square one again. And then they're going to tell themselves, fuck, I shouldn't have done that. I probably should have kept my trading scenario. I probably should have done that. Probably should have kept it. But by the time that's happened, you are already damaged psychologically. Why? Because you lost money in markets. Losing money in markets is a psychological damage. It's a psychological hole that is quite hard to get rid of. It is easier said than done. I'm sure you've all expected it yourself, and you've all seen it yourself, right? You start being not so confident in your TA. Even though you were right historically, you start being, maybe I was just lucky. What if it was just luck? And, you know, you start changing things, you start tweaking things, and so on and so forth. And your outcome, what you get out of it, is going to be completely different to what you started. And it's going to be like Chinese whispers, right? One guy says one thing to another guy, the guy says one thing to another guy, blah, blah, blah. And the end of it all, you know, what the guy said originally is completely different to what the guy had at the end, right? Why? Because people's perceptions and ideas and people, what they think they saw or what they heard, is going to change by person, because of the experience they've had, because of the things they've heard, the things they've seen, right? Not all humans are the same. So why are you thinking the same? The answer is you cannot. This is the fundamental things that people lack in any trading, and they don't teach this shit. This is the main thing that they should teach, but they don't. Why? Because it is hard to teach this stuff. And actually, the obvious reason is that they can't, because they don't know themselves. That's why they are selling courses, because they don't know themselves how to utilize the information that they know. Because using or having information doesn't make you a good trader. Implementing that information consistently makes you a good trader. So if you want to be a good trader, knowledge isn't the issue. Consistency is your issue. Knowledge is very easy to grasp. You watch this video 10 times, you're probably going to get the gist of it, 90% of the what I talked about. You're all adults, you're all educated people, relatively. So it's not going to be hard for you to understand a lot of the logic. And it is very logical. But the harder truth is, it is going to be harder for you to implement because you have scars. You have been damaged, quote unquote, by the market before. And you're going to keep looking for faults in your TA. You keep going to saying, oh, that can't be right. It can't be that easy. He explained it to me, but while I'm doing it, maybe I did it wrong. Right? It's the same. Like I don't want to relate this thing to real life, and I'm gonna have to relate it to real life. It's like when you're dating, and it generally happens with women, and it obviously happens with men as well, but it's mainly with women. Women have bad boyfriends and girlfriends historically, and what they do is that they project it to their current boyfriend or girlfriend, right? They look out for it because they don't want the same shit to happen again, without even understanding that the current guy is a different guy. It's not the same guy. So the current trade is a different trade. But because you are psychologically, quote unquote, damaged, because you lost money before, you look at your current trade as the same trade that you lost money with before. Right? So whether you realize this consciously or if it's subconsciously, and it could be either, it could be conscious or subconscious, it could be either or. But you need to realize it, because the first step of improving yourself, it's going to sound cheesy as fuck, but first step of improving yourself is understanding where you are wrong. Where you are wrong, what mistake you did, and acknowledging that, and then moving forward. Again, it sounds cheesy as fuck, but it is what it is. Okay? You have to be an alpha in trading. Fuck the bitches. You know? Fuck about, you know, what they thought about. All right, do your shit. Improve your trading. Improve your current scenario. Forget about the other things that happened before. And improve your current scenario. Keep improving what you should be doing, trying to analyze it, try to ask questions. Now, this is the idea of asking questions comes into play in chat. All right? Because this is, I know I'm going in terms of the beginner session in terms of TA, and I'm also going the psychology, because what people need to understand is the psychological side of making money in markets is very hard, guys. It is very fucking hard. It is not easy, especially if you are damaged from what happened previously. Right? And I'm sure you guys already know this, and I don't need to lecture you on this, but if you haven't been damaged, if you haven't lost money in markets before, this thing, what I'm explaining today, is going to be a little bit more easier versus people who have lost money in markets before. It's just going to be easier for you. That's just going to be the case. Right? Now you're going to argue and say, oh, you know what? Oh, nothing phases me. Nothing bullshit. You know, you're alpha shit, right? But it obviously does, because the outcome isn't what someone who is unfazed shouldn't be. You know, if the outcome isn't that if the result says you are phased, then you can't just say, oh, I'm not phased. Like, no. The outcome pretty much proves that you are. Right? So you have to understand these things. So I know this video is pretty long and, you know, blah, 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 but a lot of TA, just a quick TLDR in the end, a lot of TA in terms of knowledge of price action, TA, can be learned very easily. But the rest of the psychology stuff, the actual implementation of said knowledge about TA, about charting, can be very hard to implement. Because if you are wrong, you're gonna lose money. And that is scary. So to get rid of that psychology, to get rid of that fear, what I always say to people is reduce your risk. Rather than risking 1% of your account, risk a 0.5%. If you're still scared of losing 0.5% of your account, reduce it again to 0.25% until you get to a point where you are not scared of taking the trade. That sentence right there is probably the most fucking important thing that anyone has ever said to me in my 13 odd years career of trading. That right there is probably the most important thing you should understand and acknowledge and do. Okay? So, that's the end of it all. Hopefully you understood a lot of the things, and hopefully things were clear. Right? Now, of course, a lot of the nuances you'll find on the stream, so that's there. So I'm going to end the recording here. See you later.